Hello, everyone, and welcome to a special Zoom edition of Pandemic Proofing Your Portfolio on the Wizards of Dalal Street. I'm Ramesh Damani. The author Ayn Rand used to say, it isn't a question of who will let me, but it's a question of who will stop me. Well, for a number of years, no one has been able to stop the rise of a local hometown girl to a global investment guru who shattered many investment ceiling. She has worked with George Soros. She's written a book called Non-Consensus Investing, which I'm proud to show here. And she's the only Indian, male or female, part of the prestigious Barron's Investors Roundtable that appears every year. Currently, she hangs her hat at Ariel Investments, where she is the Chief Investment Officer for the global and international portfolio. Please help me welcome Rupal Bhansali. Rupal, welcome to our show.
Thank you. My pleasure to be here.
Yes, Rupal. Rupal, I read your book, and when people turn 18 in India, you talk about cricket, you talk about Bollywood, you talk about makeup, you talk about making out, you talk markets. How did your early childhood influence your career?
Well, I grew up in a family of bankers and brokers. And, it was a roller coaster ride for me because the way the markets fluctuated, our family fortunes did. So at a very young age, I realized I had to understand money because it seems to influence my life. So I just got intrigued with finance at a very young age. So I'm lucky I had a head start.
If I'm not mistaken, your father was in Dalal Street at that time?
Absolutely. A proud member of the Bombay Stock Exchange back then.
Which I am too, so maybe we'll brush hands sometime. Rupal, your big break was when you got a scholarship by the Rotary Fund to go and study in Rochester, right? What was your big break into the world of finance? It's a very exclusive, male-dominated club. How did you break into the inner circle of money management in Wall Street?
Well, I think the good news of Wall Street is that it is a meritocracy, and it's a place where your work can speak for itself. So I think having grown up in India, having studied in India, having worked in India, and learned from some of the best people, and I think I was just blessed. I mean, a lot of Indians, tend to be fairly analytical, and that skill tends to be very useful on Wall Street. So I was fortunate that, I got the right platforms and the right people that I surrounded myself with, where I could express, my analytical abilities. And then, as they say, the rest is history. One thing led to the next. It's been a long journey. It wasn't without its ups and downs. But on balance, I would say that, it's great to be in a country and in a profession where your work can speak for itself, because I certainly don't know how to.
And instead of working on Dalal Street, you wanted to work on Wall Street. Why?
Well, in active management, and I'm a stock picker, if you're an athlete, you want to compete in the Olympics. That's just, the penultimate ambition if you're an athlete. And in terms of investing, the most efficient market in the world is the US, the S&P 500. So if you want to be the best of the best, you have to go and compete and beat that market. So that's what got me to Wall Street.
Right. Talking about competing, the markets recently, your old boss, George Soros, called this the crisis of a lifetime. But Wall Street seems to be beating to a different drum. Is there a disconnect between Main Street and Wall Street at this time in America?
Big time. I think it's this fear of missing out and this mantra that often gets repeated and followed, which is don't fight the Fed. This is a market that I thought was on steroids because we'd been primed with so much monetary stimulus over such a long period of time that we were addicted, to stimulus. And anytime the Fed withdrew it, there was a tantrum. And now we are on opioids because the kind of stimulus that has come away, and I understand why. Obviously, COVID is an unprecedented health crisis and a global one, and a pretty serious one at that. But nonetheless, there's a lot of excess money in the system that has been released in a very fast, at a very fast pace. And that excess money has gone into financial assets, in particular risky assets. And that sort of put a bid on the market, which I think is inappropriate, but nonetheless understandable.
From steroids to opioids, that's a great tagline to remember. Your book, Non-Consensus Investing, but the broader point you make that whether it's in investing or in the world, it is non-consensus investing or non-consensus thinking that has made our world. Can you give us some examples of what you meant by that?
Sure. Ramesh, in most professions, if you, or in any activity in life, if you get the answer correct, you're off to the races. I mean, if you are a student and you give the right answer in an exam, that's all it takes to succeed. If you're a doctor, you get the right diagnosis, you prescribe the right medication, you're correct. That's all it takes to succeed. In investing, it's not enough to be correct. Because if your correct answer is the consensus answer, it's already in the price. So not only do you have to be correct, but you also have to prove everybody else's view incorrect so that you can arbitrage the difference between your correct point of view and other people's incorrect point of view. So that's why I titled my book, and frankly, I think it's the most important thing people need to understand about investing is that it's not enough to be correct. You have to be non-consensus as well as correct.
You talk about investing through conventional wisdom and investing in your style, which is non-consensus investing. Can you tell us what is the difference? What are the key philosophical differences in the approach that you advocate as opposed to conventional investing?
So I think the most important thing people need to understand is, markets care about fair price discovery. And any participant in the market, man or woman, quant or qualitative, bottoms up, top down, it doesn't matter what approach you have to investing. Anybody can have any investment style. The way to succeed, though, is if you help the market achieve what it wants to achieve, which is fair price discovery, you get rewarded for it. If you distort prices, you're going to get penalized for it. And I think that's not sort of conventionally how people think. They think there's just one way to skin this cat or one approach, to investing. But I would actually argue you can have very diverse approaches as long as they solve the end game of fair price discovery. Now, take the example of active versus passive. It's obviously been a very hot debate in the Western world. And as an active manager, I'm at in the front lines of this controversy. And I think that passive is argued as being low cost and therefore, a great solution for investors. And I don't deny that it does have low entry costs. But the question even a passive investor has to ask themselves is, passive is a vehicle. The underlying investment strategy is really to buy the largest market cap stocks in their proportion in the benchmark. Why do you think that particular strategy is going to restore fair price discovery or achieve fair price discovery? And what if it enables price distortion? Well, that's a recipe to lose money. That's what markets penalize. So I think the framework of investing, people have forgotten. You need to solve what the market wants to solve for. Only then will the you. And again, active can be practiced in many forms. Passive rides on the coattails of active. So I think these are the kinds of unconventional concepts that I want to bring back to the basics. Why do markets exist? They exist to discover fair prices. Either you help that cause or you hurt that cause. And depending on which side you choose, you're going to be at the receiving end of a payoff or a penalty.
So, Rupal, the passive investing that you're criticizing, or the ETF investing that you're criticizing, has led to huge bull runs in stocks, the FANG stocks, for example. And you've spoken very critically of the arbitrage between intrinsic value and actual value of these stocks. In fact, you've been very critical of the most glamorous stock in America, Apple. What is the case against these stocks? They have proven very resilient and they've given great appreciation to investors. But why are you skeptical of them?
So again, it's bottoms-up research on these companies, and ultimately, stock prices are about what are the expectations embedded in them. I'm a big believer that instead of trying to figure out not just what can go right in a company, and that's what people focus on in the FANGs or in a lot of these market favorites, you always have to ask yourself what can go wrong, because investing is about figuring out not just the return potential but the risk potential. And I think that a lot of the risks in these investment business models are being underestimated and therefore ignored and I would say you're not being paid for the risks. So take Netflix, for example, which of course is one of the things. And I'll get to Apple in a moment. I understand that's your question. Take Netflix, for example. Clearly, it is an example of a successful business model, which was first in its category, to encourage us to view content, via streaming. But you fast forward a decade, and that's kind of where we find ourselves now. This company is no longer unique or exclusive in in that idea or that business model. There are many, many other players in the marketplace in the US, angling for that same outcome and the same viewership. Whether you have, Disney Plus coming and nipping at its heels and actually taking away and back a lot of content that Netflix got in the early days at a very low price. So part of the genesis of Netflix was getting access to content at a very low price because the studios, whether it was Time Warner, CBS, etc., did not realize what they were giving up when they signed on those content deals. Now what Netflix is finding, in order to secure content, it's an arms race. They have to bid it up. And that has resulted in significant cash burn for the company, despite its spectacular top-line growth. And the other thing about Netflix is the content is not as exclusive. The vast majority of it is actually to be found. The top 10 shows, out of the top 10 shows, 8 of the 10 shows actually belong to someone else. And a lot of those content studios are withdrawing that content from Netflix. So I think these are the kinds of forward-looking risks that you have to look at. Not to mention Disney's coming up with a content offer that is priced at half the rate of Netflix. Netflix has had to raise prices in order to make its business model work because content costs are escalating, so subscription revenues have to escalate as well.